All right, everyone, we'll go ahead and get things started here tonight. It is 6:05. I want to be respectful of your time. Thank you, everyone, for coming out tonight. We're still going to have more folks arriving, but that's okay if you show up a little late. Of course, we will have the recording available tomorrow. Thank you, everyone, for coming out this evening. We really appreciate you giving your evening or sharing your evening with us as we unroll a really new concept that we have been perfecting for quite some time now, something we're really excited to share with you, taking what we already know about outdoor hospitality and rolling it into a very unique investment vehicle. So we would like to present with you tonight the Outdoor Hospitality Sun and Fund, created and operated by Happy Camper Capital. So I'm going to introduce myself and the rest of the team who's present here tonight. I'm Adam Lundy. As I mentioned, I am one of the founding partners of Happy Camper Capital. My co-founder, Justin Hoggett, is on with us tonight listening. He is at his daughter's music recital, and we do value family first in our company. So it is completely understandable that he's not on video with us this evening. However, he is present. I will let the rest of our team here introduce themselves, beginning with Ramesh Nachapan, Bradley Claudianos, Don Spafford, and Justin Nanny, who are present. Ramesh, if you could lead us off.
Right. Thanks, Adam. Really appreciate everyone taking time and joining this. This is Ramesh Nachiappan, and I live in Avon, Connecticut, and have been involved in real estate for the last 14 years passively and 8 years actively into the, this unique RV park campgrounds and marinas for some time now, and very glad to be part of this wonderful team. And I play the investor relations as and I'm part of the Happy Camper Capital as well. Just on to Bradley.
Thanks, Ramesh. Hey, everybody. Thanks so much for being here tonight. We really appreciate it. My name is Bradley Claudianos. I'm part of the acquisitions team here at Happy Camper. We look for a lot of off-market deals, off-market opportunities, and so far we've been able to produce that. So that's part of my job here at Happy Camper, and thanks for being here.
Don, if you could go ahead, take a second.
Sure, yeah. Those that don't know me, I'm Don Spafford. I live in Idaho Falls, Idaho. I am happy to be part of this team. I'm one of the partners with Adam and Justin. I help oversee, of course, with our investor relations, and many of you are here today because we've spoken in the past, or maybe you see me on LinkedIn through some of my fun posts that I try to do to help bring attention to this amazing and fun space. So glad to have you all here, and this will be an exciting presentation tonight.
Okay, and that brings us up to Justin Nanny.
Yeah, everybody, I'm Justin Nanny here in Colorado, here with Adam and Justin as well, on the acquisitions team. So yeah, just sourcing some of these deals that we'll be unrolling for you guys. So very excited about it, and can't wait to show you guys what we got.
Yep, Justin's got one we're going to be sharing with you very soon. We'll maybe give you a little teaser to it at the end of the evening. Pretty great opportunity that we've got coming up. And then, of course, joining us also tonight is somebody who's actually partnered with us from the beginning, maybe not with the team originally, but John McGaw is on with us tonight. John is someone who partnered with us in our very first deals and is now taking a more active role with the team. So, John, pleasure having you on with us this evening.
Thank you. Good to be here.
All right. Excellent. Well, let's get the party started. So obviously, as I mentioned, this is a fund that we are unveiling that is being operated by Happy Camper Capital. And this is going to be a fund of outdoor hospitality properties. We had several requests from investors of ours who had goals that we were looking to satisfy with this. Some of those being that they were first off venturing into a new asset class, something they weren't familiar with. They wanted to feel a little more comfortable with what they were getting into. This is an alternative asset class from the traditional sense compared to multifamily, self-storage, several of the others out there. Frankly, a lot of folks aren't finding the deals that they want to invest in those spaces. So they're coming to us, but they do have questions. So the goals of this fund are going to be to hedge some of their concerns by investing in multiple markets, and also allow us to smooth out the potential cash flow distributions on this by having campgrounds that are in different seasonalities, because this is a seasonal asset class. Doesn't matter which part of the country you're in, there are going to be peak seasons and off-peak seasons, and there are times of the year that even though we project really great cash flow returns, that maybe you get most of that cash flow in 2 quarters of the year and the other 2 not as much. So the goal of this is going to be to help smooth some of that out. We'll talk a little bit more about what that looks like once we get things moving here. So just to give you an overview of what the structure of this fund is going to look like, a lot of the terms in this are going to be very similar to Happy Camper Capital offerings we've had in the past, in the way we're going to operate this, the way we're going to structure it, that our partner Beyond Our Camp is going to be managing the properties that we put into the portfolio. Some of the ownership structures even the same, that, for example, that we're looking to do a 65-35 structure. We are offering a new share class system on this offering. We are offering A, B, and C share class based upon the size of the investment made. Now, we're going to share some great details about that really provides opportunity should you maybe only have a limited amount you can invest early on, but you'd like to increase that amount later, you will have the opportunity to level up a share class. That is something that I don't know if any other operators are offering. That's something that we were really proud to put together for you all. With that, there's going to be a tiered IRR threshold on our ownership structure for when at disposition, the IRR is calculated based upon the share class, just to help level things out for the Class A's who would otherwise potentially be disproportionately moved over. We are doing quarterly cash flow distributions as we've done with our other offerings. What we are doing, and this is something that was important to us, is to make sure that this was a no fee upfront fund, meaning that we aren't taking an upfront fee on investments going in. We're only taking fees on actual deployed capital deployed into opportunities. So if we collected money and we never invested in a deal and returned it back, there's no fee removed from it. So with that, the fees will be based upon the deal size. So we do have an acquisition fee that ranges 2 to 4%. The higher end is typically for the much smaller deals. And of course, the lower end of that is for the much more high price deals. Happy Camper does take an asset management fee of 2.5%. We do pay Beyond Our Camp a 7.5% property management fee. One update with that, just to give you some comparison on property management in this space, it is a very involved business of managing an outdoor hospitality property like a campground or an RV resort. Most other operators in the space who are managing these properties charge 10 to 15%. Beyond Our Camp is actually offering third-party management to other owners at this point between 10 and 12%. So we are actually discounting the service to Happy Camper offerings. And of course, if there is a loan taken, any debt used for the property, which we are intending to leverage debt into the properties put into this fund, there is a fee for any guarantees or any steps that we as operators have to take to acquire that debt. Let's move forward here a little bit. So the strategy of the fund, and of course, just to give a little foreshadowing, we are unveiling an opportunity in this. This would be, by traditional standards, what's considered a blind pool fund, meaning that you're going to know the concept of what we're investing in, but you're not going to know all the assets we're investing in specifically. The great thing is we have one lined up tonight that Brad's going to be sharing with you shortly. That's going to be the first opportunity we put into this fund, provided it closes. so you can get an idea of the things we're putting in. But as I mentioned, of course, one of our goals in this was to create year-round cash flow distributions. We do have a lot of investors who are building their living strategies, their passive income, early retirement strategies on consistent cash flow distributions. And as I mentioned, this is a seasonal asset class that does see peaks and valleys along the way. It produces great cash flow. It's just sometimes in one property, you might get a lot of it in 2 quarters, and again, less of it in the other 2 quarters. So this model is a way that we can have northern states where their peak season is going to be in the summer, and southern states where their peak season is in the winter. And by putting those together, it's going to help balance out some of those cash flow humps, peaks and valleys otherwise. Again, the other thing we're looking at too is diversifying into multiple markets. Now, when I say multiple markets, I mean, it is going to be in the United States. We're going to be focused more on the asset class than on the market. We are going to be targeting markets that are in demand, that are vacation destinations, or that are just known travel hubs. And doing this is, of course, going to help us mitigate risk against natural disaster. Whereas if we put all our eggs in one basket on a property in Florida, let's say, and a big hurricane comes through and damages it, we could be out of business for some time. But if we have some other properties in other areas, it gives us a chance to help balance out some of that risk should something like that happen. And as I mentioned, of course, we're going to be putting in what we call blue chip properties. So a blue chip property that I'm referring to is one that is working on a proven model. It's one that's already been producing itself. We're buying operating campgrounds in this portfolio. And we're going to be looking for ones where we're not doing anything experimental. We're not testing a new market. We're just growing on an existing business. So meaning that, we're taking something that is already at the level we want it to be at. We're adding to it, expanding it, just focusing on making it better, not taking any big gambles in turning them around or putting something in a market that hasn't been experienced. The benefit for the investor in this is instead of just putting your investment into one property and again, having that risk exposure, you now have the opportunity with this one investment to be in multiple properties. We're estimating that based upon our range of deal sizes, this fund could hold as few as 4 and as many as 8 properties in it when it is closed at the $25 million goal that we are setting to achieve in the next year. So as I mentioned before, Beyonder Camp is involved. And the great thing about Beyonder Camp is we control Beyonder Camp. So we do have control over the management company. And of course, its goals align with our goals, which is to make these as profitable and stable for our investors as possible. So Beyonder does oversee any construction, any expansion, any improvements that need to be done to execute the business plan that we form for the property. And then, of course, it oversees the day-to-day operation. We'll talk a little bit more as we get further along as to what Beyonder's role is in the property. So some of the things that we do in partnership with Beyonder, of course, on the Happy Camper side, our job is to get in front of the property. As Brad and Justin mentioned, they are our acquisition team members. They are outsourcing these deals. This is a hot asset class, one where we've seen cap rates compress drastically. Just in the couple of years we've been doing this. When we started off, the cap rates were right around 12 to 13% that campgrounds were trading at. Today, a good deal is one that you get at about 8% cap rate. I mean, that's a good deal through a broker. And of course, the thing is with brokers, of course, is they're doing a great job for their clients, getting them top dollar. That doesn't always serve us well when we're building a property in with this model. So Justin and Brad have done a fantastic job of getting in front of properties. That's a first part of our value proposition is we're getting in front of properties, typically well below market value. They've got great experience sourcing these deals. They know how to give an initial glance and they put these through the sniff test, and they do a fantastic job underwriting them. They work with our team to make sure that the underwriting fits and to build up the business plan. So some of the things that we do that we look to incorporate in these properties, again, because I said we're buying operating campgrounds. So we're just looking to improve upon what's there is revenue optimization. So putting in online reservation systems, a lot of mom and pops in this industry still, I would say, I don't have a current figure, but last I heard it was 85%. I'm gonna guess it's still north of 80%. Mom and pops in this business. A lot of them don't have online reservations. It's the way of the future. I know I've spoken about it before on other opportunities we presented, but if you don't have online reservations, you are going to fall behind in this business. One of the benefits that comes from that is what we call yield management, which allows us to actually improve the rates based upon the occupancy. So we can maximize the rates we're getting in the transient RV destinations that we are buying. It also allows us to connect to outside travel agencies. So if you ever use a website like Expedia to book a hotel, we have the opportunity to use sites like Expedia for our cabins and glamping opportunities, but also sites like The Dirt, which is a camping site to help find RV sites. So great opportunities there. Of course, always looking to expand the rental units or upgrade the ones that are already in place. Sometimes this means improving the sites, the existing sites, to maybe a premium site by adding patios and other amenities that will increase the nightly rates. Other times it's putting a glamping unit in place of a tent site, or even sometimes that maybe an RV site that was tough to access. And of course it could come all the way up to purchasing additional acreage and developing on that acreage if the demand is there. Adding amenities, both revenue generating, direct revenue generating and indirect revenue generating. We look at everything we can do to help improve the business itself through different sources, and of course improve our nightly rates or alternate revenue sources. And then of course, one of the things we focus on is the other end of the profit spectrum, which is reducing expenses. That's one thing that Beyonder does well, just through economies of scale, by being able to provide services in bulk across the whole portfolio to each, and that's available to each property within. And then of course, we've got tax benefits that we are working on pursuing right now. Don has been actually working pretty hard on this right now, getting 4 cost seg studies set up for the end of this year, so we can look at providing depreciation back for our investors. So we can cover more on that a little later, but just want to give you an idea of some of the things that we look at and plan for in our business model. As I mentioned, Beyonder Camp is the operator. Beyonder Camp is also the flag that we fly on the campgrounds that are in our portfolio. And as I mentioned, that's going to begin operating on other campgrounds as well too. We've actually just added, we've got 2 full-time staff members at the corporate level for Beyonder Camp, Jill Shepard and John Goosanders, who couldn't make it on tonight. They're actually both on the road right now working on a couple of our properties. They are 100% full-time committed to Beyonder. They actually are both full-time RVers with their separate spouses. And they go from property to property for us, the ones we own, helping optimize them, helping the team out, to the new properties that we close on or who we take under our brand, who are going to be turning over to Beyonder Camps, helping them implement systems, optimize, and really improve the businesses. So the relationship with Beyonder is fantastic, and we are in the very unique position, as I mentioned, to own and control our management company. So as this was an overview of the fund, as I promised, we do have an opportunity in the fund that we're going to be sharing with you tonight. So I'm going to turn the floor over to Brad here in just a second to share his opportunity. But first, we're going to give you a little bit of a teaser of the property, and then we'll let him talk to you about it. All right, Brad, the floor is yours.
All right, so not your typical RV park, what you might imagine when someone mentions an RV park. It's a very nice property. As Adam mentioned, we invest in blue chip properties. This is a cash flow producing property as is right now, and we're getting a great deal on it. So we're very happy to share it with you, and we're very happy that you're here tonight. These are just some of the rough numbers for this deal. Purchase price is $8 million. Projected IRR 5-year, 22%. Minimum investment for the fund for this deal is $100,000. We do have a large CapEx plan because this property includes we're also going to purchase an adjacent parcel of land, which is 9.6 acres. With that land, we would be able to produce another 70 plus sites. So that's the kicker here, is that we'll be able to add to this property, add to the overall size. That's where you would get your 2.4 projected equity multiple, as well as that $17 million exit 5-year property value. Next slide, if you can.
Yeah, you got it.
Thank you. So this park sits just 15 minutes from Lake Charles. If you don't know Lake Charles, it is one of the larger cities in Louisiana. It's known for its 5-star casinos. There's also numerous nature preserves in the area where you can see alligators and migratory birds. This property sits 5 minutes south of I-10. So it's a 2-hour drive east of Houston along I-10 and 3 hours and 30 minutes west of New Orleans. So anybody traveling between those cities would come just within 5 minutes of this park. The park features 134 RV sites, as well as a 35-unit motel and ample amenities. You have 2 swimming pools, a fishing pond that's stocked with plenty of fish. It also has a gym and a game room, and then a bar area that's not utilized right now for the public. It's only for those staying in the park. Some low-hanging fruit on this property is the opportunity to add online reservations. As it sits now, when you want to book a space or a motel room with this park, you actually have to call and hope somebody answers before you actually be able to reserve a room or a space. So just adding online reservations will be a huge revenue stream for this park. Also, dynamic rates. For those of you who aren't familiar with the hotel industry, sometimes you'll notice that rates differ based on the day, based on the weekend, events happening in the area. So we'll also incorporate dynamic rates, and then just charging back for electricity. Now, this part of Lake Charles, this part of Louisiana, is actually known for the oil and gas industry. A lot of the similar parks in the area are simply setting up just like you would think of a mobile home park. So they're more focused on campers that come to stay for a while. And included in that is that they only pay a flat fee for the month. So what we would do is actually charge those campers for their electricity use, which is a major source of expense for the park. Already, I mentioned there are tons of amenities at this park. However, in terms of RV resorts, something that we could add would be rental golf carts, patio sites, which, if you're not familiar with a patio site, it is just imagine a very nice porch with a fire pit and furniture, so that it's it's a premium type of place to stay, opposed to just having a picnic table in front of your RV. We'd like to add to the game room. There's also a very large indoor pavilion that we could use for rental, say for baby showers or wedding receptions. Like I mentioned, the upside with this property is just charging back for electricity and software improvements, just being more present online. The town of Sulphur, as I mentioned, it actually has currently $11 billion in projects. So the parish where this property sits has $11 billion of mainly oil and gas projects under construction, and another $65 billion worth of investment in oil and gas, mainly type properties, to be under the last phase of permitting. So a lot of investment in the area, and this town is poised for expansion. Just another overview of the property. It sits on 16.7 acres, 134 sites are the campground. You have the 35-unit motel. The occupancy rate for this park is very high. The RV sites sit at 80% average. Now, just to give you a glimpse into this industry, generally 50% for RV sites is very impressive. Now, the reason why the occupancy percentage is very high is due to the nature of the park. Most of those staying in the park are there for the month and not by the day, but we plan to kind of scale that back over our time with the property and change it to more of a transient park, as those parks are more profitable and there's nothing like it in the area at the moment. They're all kind of posed for workforce. These are just some photos of the park. This is a fish cleaning station. Later on, I'll show you where these are positioned with a map. This is the adult pool. So it's kind of positioned like a lazy river. That's a hot tub right there. An aerial shot of the park, you can see it's plenty full. And then you have the indoor pavilion that I was saying you could rent out for weddings and baby showers. That is just kind of our pro forma rate for the RV sites and the motel. The comps support those kinds of numbers. Yeah, next slide.
And Brad, just to make a point, of course, that's the current size, the 134 sites.
Exactly. So we're also looking at expanding the park as well. As I mentioned, currently most of those campers in this park are on a month-to-month basis, and there's only 14 sites that are set for transients. Currently, the occupancy rate for those 14 sites is 65%. So that is massive. So we believe by building these 70 extra sites on this adjacent parcel of land, we should be able to capture those rates, that occupancy rate, by expanding the park. The park it has city water and sewer. It has a packaging plant, and it gets its electricity from the city as well. Now, this is just a map of the park. It's map of the park. Yeah, you can go to the next one. Okay. Thanks. So this is that parcel of land that I was talking about. It sits adjacent to the current RV park. It kind of butts up right against it. It also comes with a single family house. That could be a great opportunity to run. We might be able to have a small store there, or it could be a short-term rental. We have that property under contract, and we're just making sure that we can get the proper zoning and the site expansion that we'd like.
And just to clarify on the numbers, the purchase price we showed on the first slide, which was just over $8 million, was actually inclusive of the land purchase as well too. The campground itself is under contract at $7.2 million.
So just a summary of the income. As you can see, the difference between the year one and the year two discrepancy is based on when we would get those 70 extra sites completed. Another factor that's increasing the income is actually just scaling back the number of seasonals staying in the park. We're also looking at the same model with the motel. A lot of the motel guests are actually paying by the week, and they work in the oil and gas industry. So just by scaling that number back of those staying for the week, we can definitely increase our revenue by getting people staying for the night or for a couple days instead of week by week. Currently, you can see the electricity is listed as an income, as we're going to charge back, charge those campers for the electricity they use. One way that we're going to do that is actually with wireless meter reads. It's a great new kind of, it's a great new part of this industry. And what you can do is actually wirelessly read the meter. So when somebody checks in, it'll do a meter read. And when somebody checks out, it'll also read the meter again. So they're being charged for the electricity that they used while they were there. Another opportunity is golf cart rentals. Some of our other parks, golf carts, they do very well. So we're going to add golf carts into this business plan as well. And as you can see, we didn't include the income for the pavilion. Also thinking about rental bikes, just to show you that there are extra opportunities there that we haven't included.
And Brad, I'm just going to jump in and add a point on the wireless meters and the electricity chargebacks. This is an industry trend we picked up on about a year ago. If you think about it, the way we're headed with electric vehicles, there are more and more on the road today. Last year, when we were at the Outdoor Hospitality Conference, they were just talking about electric pickup trucks coming out. Now, the Rivian electric pickup truck is out, the Ford F-150 Lightning, Dodge and GM are both releasing theirs. They're maybe not too capable cross-country vehicles right now. However, it's only been 1 year. As we know, the way technology advances, another 5 years, they are going to be staples in our campgrounds. And the thing is, if we have someone show up to a campground with a depleted battery in their electric pickup truck and a camper behind them that's 50 amps with 2 air conditioners on top, it is without a doubt that they're going to use more electricity in one night than anyone else in that campground is going to use in a week. So if we aren't metering for electricity, we are going to be losing money in campgrounds. And there are a lot of operators out there who have non-metered sites who are going to be paying dearly for this. It's only traditional in our industry that you meter for monthly campers in the past. However, the trend has already started. We know several operators who are already doing this with great success. We're setting a new standard that you pay for the electricity you use. It's added on. And as Brad mentioned, we have wireless meters that are connected to our reservation system. So the reason a lot of the mom and pops didn't charge for weekly and nightly in the past is because they would have had to send a person out to actually physically read the meter. These are tied to our online reservation system. So when they check in, it takes a meter read, and when they check out, it takes a meter read. So whether they're there for 2 nights, 2 weeks, 2 hours, it doesn't matter. They pay for the electricity they use. The other thing this does too is it stops from revenue theft on site income. We do get a lot of phantom campers who come through in the middle of the night. They'll plug in, they'll use your power, they'll use your water, they'll take off in the morning before you come out. These meters actually shut the pedestal off at the site when there's nobody checked in to help avoid that from happening. What this also does, and you'll notice when we look at the expenses historically on this campground, is the electricity has been a massive, massive expense. And when there's no accountability for the camper who can just run their air conditioner 24 hours a day and keep the thermostat set low, they're going to abuse it. And that's what's happened. So the underwriting Brad has done here is actually extremely conservative in that he did not reduce that electricity number. He kept it trending upward, including for the new sites that you see coming on in year 2. When that chargeback goes up, that's directly correlative to our electricity bill, when in reality, it will likely go down along the way too. So Brad, I'll let you jump back in on the expenses.
All right. So as you can see, we have the expenses here. We're going to budget for a higher advertising spend, just to be visible. Currently, the motel room, you can't find it on booking.com, Expedia. You have to call physically and book a room. So just by being in the game with the other motels, we will increase our revenue that way. As you can see, the jump from year 1 to year 2 in almost every expense column is just due to the fact that there will be 70 plus more sites. We kept our repairs and maintenance budget about the same. Now, currently this park has a massive repairs and maintenance budget because they're doing most of their services in-house. What I mean, the lawn mowing expenses in-house. Sorry, they're doing it third party. So the landscaping is done with a third party vendor, as well as the pool upkeep. It's third party. The sewer plant is also a third-party vendor. They even use a sanitation company to put hand sanitizer units in the bathrooms and the laundry rooms, and we could cover that on our own. However, we didn't actually add that as a decreased expense, so we kept our repairs and maintenance expense the same. However, we would expect that to go down. The insurance premium, I'm sure some of you would assume that hurricanes might be something that comes up in this area. And just to address the elephant in the room, we have budgeted for a massive, very large insurance premium. I would say $45,000 is standard in other states with this size campground. You can see for year one, we have projected $85,000 and $102,000 in year two when we get those other sites online. So just to really pad it and make sure that we have that in the budget, we've planned for it.
And Brad, the main reason for that, of course, that we're estimating that now is we have yet to get the actual quote back. The insurance underwriters are extremely slow in responding. So nearly doubling it is probably a good place to start. And we'll, of course, adjust that once we get those quotes in.
Definitely.
Excellent. All right, I'll jump in on this one, Brad. Is that okay?
Yeah, go for it.
All right, super. So obviously looking at our cash flow forecast for the property here, as you can see, we do have a very massive increase in year two. And of course, this is going to come when we add a tremendous number of new sites to the property, adding roughly 50% more sites than are presently there. And then, of course, all the other optimizations we are making. And mind you, I know we've said this before, and I'll say it again, we underwrite conservatively. I know every operator in the space says that. As Brad mentioned, it can't go understated that we left a lot of expenses in there. We padded a lot of expenses heavily, and we also didn't include a lot of potential income streams. Because as I mentioned, we really don't like to forecast income streams that haven't had a history. So as Brad mentioned, that there is a bar on the property. It's more right now really of a rental community room that has a kitchen on it, but it's right by the adult pool. So there's a fantastic opportunity to put a bar and grill in. We have great success with one of these at another one of our properties already. It's a very streamlined operation. It's easy to run. It's something we intend to put in. At the other property I'm referring to, it makes about $90,000 a year. And we could put something like that in here, which could perform similarly. We haven't even included those numbers in it. So there are a lot of things that we are intentionally leaving out of here. So these numbers, again, as I mentioned, are very conservative. Even with debt effect factored in, this one shows to be a great performer. And that's going to show up again in the final investor returns, which let me get to this here. Where we anticipate achieving a 22% IRR and giving out a almost 2.5x equity multiple on the property. We are currently under, and mind you, actually one thing too we do need to mention is we just did lock our rate. We didn't have a chance to update these numbers before the webinar tonight. However, we didn't have a rate locked in and we were planning on rates going up. This entire deal has been underwritten at 7.5%. However, we are now locked in at a 6.7% on the interest rate. So our numbers will improve on just the debt service alone. However, we do have debt lined up. It is a bank we've used in the past, Five Star Bank, who we closed our Rising Sun property with. They've been great to work with, and there's no reason we can see that we wouldn't be able to get this one closed with those terms again. So by virtue of just updating the debt service in here, which again, we didn't have time to do before our presentation tonight, that will improve the rest of the numbers in here. Brad, I'll let you take over for the business plan for a second.
Okay, sounds good. So with that large CapEx budget that I was telling you all about, we should be able to get that done within the first 2 years. As I was saying earlier, revenue optimization, some of the opportunities there would just be more advertising. We can just get more exposure for the property. That also goes with the increased visibility line there. Adding more amenities that make this park look like an RV resort will definitely help. Currently, it has great amenities that go along with a hotel. So those cater more to the motel portion of the property. Adding things like a snack bar, a basketball court, pickleball, even horseshoes, fencing in the dog area. Those are low hanging fruit that can make us look like a real RV resort that you'll find in other parts of the country. The development of the 70 new sites, that would happen within the first 2 years. Also, those sites, we would dedicate most of them to transient sites so we can demand a higher use rate per site than if you're just charging monthly. As well as the snack bar. The snack bar is a great opportunity, as this is a very small town as it sits right now, although poised for growth. There aren't a lot of options for things for locals to do, people to do in the area. So by opening that up, then that's another opportunity for this park. Just to go over some of these ideas with you all so you can get a visual of it. Now you can see on the left side of the screen, you have the community fire pit. Where that sits right now, it's just additional parking. There's a couple boat trailers that sit there, but there's really not a lot going on. A community fire pit is a great place if you've ever stayed at an RV park or a marina, just to get together with other people that are traveling there and really share your experience, where you're headed, where you're going. It's a great way for people to get around and talk to each other. One of the best ways to get reviews is that those who stay in the park actually communicate with one another, and they're able to share their experience. And that way, if they had a good experience with others staying in the park, that reflects on our ratings as well. Inside that additional parking, basketball and pickleball court, it'd be a great place for them just to take advantage of that unused space. There's already a dog area in this corner. However, it is not fenced, even though it actually says that it's fenced. It's not at the moment. So a lot of people love to travel with their pets. I know I do. So it's a great opportunity to be able to take your dog to the dog park and do that in the place where you're staying. That snack and daiquiri bar, that's at the adult pool. That's also where the gym and rec center is. And then you have the indoor pavilion, which is currently only used for guests of the park and also rarely used. There's also a massive smoker sitting outside. It could be great for parties, those who want to rent out the pavilion. So we're very excited about the pavilion and the opportunities that it holds.
Yeah. And Brad, I'm just going to chime in real quick on some of the amenities we're adding here. I mentioned, of course, in the funds goals, this reflects in the business plan here. I talked about direct and indirect revenue generators. Some of these things, like the community fire pit, the games that we have in there, are critical in actually in indirectly improving the revenues. When you create a sense of community, as Brad mentioned, you are going to command those high ratings. And in this space of transient vacation destination properties, having the high score on Google, having the high score on TripAdvisor is absolutely important, because it is going to bring in the people you want, who are going to be the ones, the higher end clientele. We always like to say that we go for the Class A diesel pushers, which are the big buses. Those are the people we want to see coming into our campgrounds. They're going to go to the ones that are 4+ stars, and they're going to be the ones who are willing to spend the most money. So having those amenities in, even though they don't directly drive revenue like the snack bar would, they are going to help us in the long run, improving the income and profitability of the property. So take it away, Brad.
All right. So the rent analysis, as we mentioned earlier, there aren't a lot of true comps in the area for the RV, just because most of the parks that have been set up are set up for people to live, more like a mobile home park. So you can see there's plenty of comps for monthly rates, but the night high and night low rates, not much of that. Now, that is an opportunity for us, being the only one. There's no other park in the area that has the type of amenities like A+ does. So it's one of its own. To get to the Gulf, you can see that the park is referenced as the red dot. It's about a 40-minute drive to the coast. you can see just south of the park, there's a town called Hackberry, and that's actually one of the it's one of the four strategic petroleum reserves that we have in this country. There's also the intracoastal waterway just above Hackberry, so there's a lot of people that use that. You can take the intercoastal waterway from Brownsville, Texas, all the way along the coast to the Panhandle of Florida. So there's a lot of traffic coming through the area. This area has a lot of wildlife refuges, alligators, migratory birds. It's also well known for the Cajun culture. You can drive along a route called the Creole Nature Trail. It is a continuous loop that includes this property. It takes about 3 or 4 hours. You can stop and try local cuisine, see the alligators, and you can actually see them right from your car. So it's a very exciting place and a great spot to be. Motel rates, we're comparing these with other motels that you would find on sites like booking.com and Expedia. However, we're not listed. So it's hard to find, and the motel is still doing pretty well. Now, just to paint a picture of the region where we are, like I said, you have the Creole Nature Trail. You also have the casinos in Lake Charles. The Calcasieu River is the main attraction to this area with all of the water sports, as well as the economy. It's a good way to help to transport a lot of the oil and gas in the area. Some of the most common employment sectors, you have healthcare, obviously oil and gas, and retail. There are a couple universities as well. And one of the most fun things is they say that in Louisiana, they celebrate everything. So there are around 75 annual events that go on in this region in Southwest Louisiana. Some of them that we know obviously are Mardi Gras, but there's a Jeep festival, there's a migratory bird festival. So just being able to partner with some of those events is a huge opportunity for us and something that they don't currently do at the park.
All right, perfect. Well, thank you, Brad. So as I mentioned before, of course, this isn't a completely blind fund, but this is a great example of one of the many properties that we are going to be placing in this fund. As I did mention in the beginning, that we are looking to raise $25 million over 1 year into the Outdoor Hospitality Sun Fund to be deployed, like I said, along with debt in purchase of properties like this. So in the case of this property here, where at a minimum, we're looking to raise about 2.8 million. And of course, fully funded for this property would be about 3.9 million. 6 properties of this size would fill the fund. And this is probably a good median property for what we will be looking to put into the fund. Before we get to questions, I just want to talk about some of the details of the fund and in what we're looking to do. Of course, and specific to this property and its relation to it, the units that we're selling for this, the stock units, are going to be into the fund, and they will own multiples of the property. So you do see here, it mentions that the investor units are valued at $1 each. We anticipate that's going to be the starting rate. For those who get in early into the fund, that will be the rate. As the fund begins performing and future investors join, there's a high likelihood that unit price is going to go up, that price per investor unit. So for those who come in early, who are taking, so to speak, the larger risk and not knowing everything that's in it, they're going to get a better deal than those who come in when there's, say, already 6 or 7 properties and a track record in the fund in place. Those ones will likely pay a higher per unit share to get into the fund. All the details that are in this pitch deck can be found in the investor portal, both between the page specific to the Outdoor Hospitality Sun Fund and A+. They're both on separate pages within, so you can go in and you can review the diligence documents for the property and review the fund documents thus far. We are going to be taking investments only into the fund for all of the properties that are in the fund. And that's more just to make sure that the right control is in place for the investors who are in the fund, so we aren't changing the balance for any outside investors. So we aren't looking to take in any outside partners on the other properties, just the fund as the sole owner in the property, with Happy Camper Capital managing the asset, the financial asset, and of course Beyonder Camp managing the physical assets. Our planned time for each property in the fund is going to be 5 years. So again, this very much aligns with what we've already been doing with other Happy Camper Capital properties. The fund has a planned life of 8 years. And of course, our reason for that is that we are going to spend 1 year raising the $25 million in the fund. The plan will be to, as quickly as possible, of course, deploy that into appropriate properties. Now, I say quickly, however, we will scrutinize every property that goes in. We do have a certain set of standards that we look for our properties that we purchase to achieve. And this is no different in the fund. We're going to be looking for properties with a 5-year cash on cash around 15%, properties north of 20% IRR. So we have a very high standard for what we put the Happy Camper Capital name on. The same will extend to this fund here. But of course, the reason we left that to 8 years is that we could be deploying capital for up to 2 years from now, depending on when the last dollars are received into the fund and when those properties close. So then, of course, if we plan a 5-year hold for each property within and enough time to dispose of the property at the end of that time, that gives us a maximum of 8 years. Of course, if we are able to achieve our goals in less than that, we will absolutely make exits as necessary. And of course, as we've mentioned in the past too, the way we structure our deals, we want our investor members to have a voice. So we do have a very high standard in requiring a 75% vote of investor members on any of these exit decisions or sale decisions, as even who the property is sold to. Now, one benefit that we like to offer is that we have interest, we the managers have interest in purchasing the property at the end of that period from investor members based upon a third-party fair market appraised value. But again, even if we wanted to, it would still require a 75% vote of investor members. And if the vote was to sell it to an outside party, that would be something that would be at the will of the investor members to come along. So that is our ultimate plan strategy within the fund. Obviously, we've met a few of the team members here tonight. Ramesh, Justin, and Brad are all on with us tonight. John McGaw is on also. He spoke a little earlier. He's one of our capital partners who's with us. Everybody say hi to John. Then we've got myself, Justin Hoggett, who, as I mentioned, is with his family tonight, and Don Spafford, our partner in the management team. I know we probably have some questions who've opened up. This is a new opportunity that we are offering tonight. I assume we probably got a few questions in the chat. So Don, if you don't mind me picking on you to read the questions, and then we can get a few answered before we jump off tonight.
Adam, before we go to the questions, I just want to add one more thing on the fund itself, right? Because this is a 506c which we needs an accreditor in a certification kind of things, right? So it is only for 506c fund, which is open for public as far as marketing goes, and make sure we meet that accreditation criteria. On the other side, I know you mentioned it before. I have done some research so far, and I have never seen one. So probably, even though we don't want to claim it, that is a unique, but definitely one of the unique ways of supplementing the investor returns by having an entry position as Class C, and they are allowed to scale it up to Class B and Class A within that 1 year time frame. And when that happens, they go to that next tier of pref returns, which is, I have never heard of, and I have never seen one based on my research. And really applaud the Happy Camper Capital team to acknowledge this and be out there. And when we say we focus on investors and creating generational wealth, we really mean it by providing these kind of opportunities.
That's right. Thank you, Ramesh. No, great point. And yeah, we did mention that briefly at the beginning, but it is important to mention. And of course, there will be more documentation on this in the portal. However, yes, as Ramesh mentioned, the minimum investment is $100,000 for Class C shares. Once the total investment received is above $249,999, just call it anything less than $250. Above $250, we go up to a Class B share where the preferred rate of return goes up from 8% to 9%, all the way up to just short of $500,000, and $500,000 and over gets the Class A share, which is a 10% preferred rate of return. So yes, great opportunity as the deal goes to keep upgrading as we continue adding properties and performing as planned. So Don, if you don't mind kicking us off with a couple of questions. We do have only a couple minutes on the clock. I don't mind stretching it a few minutes over, but I do want to be respectful of everyone's time tonight.
Yeah, and we had a question from Ravi at the beginning. I think he was talking about the fees you were discussing early on with the management fees and all those things. I guess he's looking for more details on what those charges would be.
Yes, and so as I mentioned, the fees are on a property by property basis. And we did that so we would have a no fee upfront fund. That was the goal. So instead of having a fixed fee like some funds do, where just putting the money into the fund takes a fee, we are only doing it on deployed capital. So we have to perform on the acquisition side to be able to earn a fee, and we're scaling that based upon the size of the property to keep the fees within line. So in the case of A+ that Brad presented with you tonight, that one has a 3% acquisition fee. It's right, as I mentioned, it's right in the middle of the road. We shared a range of 2 to 4%. So it falls in line with what we would project on that. Some of the other ones that are fixed are going to be the asset management fee, which is based on the gross income of the property, as is the property management fee, which goes to Beyond Camp.
And Scott wants to know if there can be a standalone investment in A+, or if it's only in the fund and no other option for that.
Sure, and Scott, just to answer that question, or just to answer it broadly, the plan that we have is to put these properties 100% into the fund to keep the balance of ownership with the investors in the fund. The goal in that just being that if we brought another partner in at the property level, it would distribute the ownership in a way that would negatively impact the fund investors. So we are keeping these 100% within the fund. However, as I mentioned, the benefit to that being is we will be putting more properties like this one in. In fact, Justin Nanny, who's with us tonight, has an outstanding one he's been working on for some time. It's a very complex property, but one that could produce some really impressive returns. We're going to be presenting to you guys very soon. When we add other properties like that to it, you get the benefit of being in all of those properties with one single investment.
Mm-hmm. And I think it's maybe safe to add that there could be potentially some other one-off properties we do as a standalone, maybe 506B offering here and there. But yeah, most of these, especially the larger size properties like these, will definitely be made for the fund going at least until it's filled up.
That's right, and we won't stop doing syndicated deals as well. We will keep those going. We are just being very selective about the properties that go into this fund. Not to say that these are any different than those other ones. Some of those other ones might be smaller properties, ones that just make more sense to do as a one-off property, as opposed to putting it in the fund. As I said, we're putting more larger properties into this.
All right, and then someone's asking if we can explain the ROI again.
Certainly, I could talk about the ROI at the property level for A+, which I'm assuming what the question is, because the ROI on the fund is going to be
It'll change as more properties get added to it. Yeah.
I'm sorry.
I'm just saying it'll change as more properties are added to it. So.
That's right. And that's one of the big benefits, of course. It will be a blend of the multiple properties within. So, God forbid we had another hurricane come through one of these areas, which, even as Brad mentioned, this part of Louisiana has only seen 2 significant hurricanes in the past 170 years. And it affected this one. We would have the other properties performing to help even things out. So that's, of course, a big benefit. However, if we're talking specifically about the ROI of this property, the projections on the screen are based upon a $100,000 investment. It does say Class B. That's a typo on our end, so we apologize for that. That would actually be a Class C share at $100,000. However, this is projected upon that. The total return on investment shown in year 5, the $148,000 projected, is not inclusive of the initial investment. So that's how that would create the 2.48x equity multiple. Just call it 2.5x equity multiple for rounding up. If there was further question to the ROI on this specific deal, you can unmute and ask. I want to make sure I do answer the questions appropriately.
Hi, thank you. This is Dhiren. I asked this question. So how do we exit after, let's say, if somebody is done with 5 years of 1.4x and he wants to exit? So what are those How do all that happen in this business? Can you explain us?
Yes, so within the fund, and actually that's a good, I'm glad you asked the question because it did bring me to something I would have forgotten otherwise. However, when a property within the fund exits, the distributions will go out through the fund and be paid out to the investors within the fund at that time. So that's something worth mentioning, is that there will be, when those dispositions happen along the way, those will create exit distributions to the partners along the way. So the planned exit is 5 years, like I mentioned. Of course, if we hit our goals sooner and it seems advantageous for us to exit in, say, year 3 or year 4, with the appropriate vote of the investor members, of course, we have to put it to a vote, and we want to honor that relationship. We can always exit sooner and cause that event to happen sooner, which, if we were to achieve our goals across the board, could shorten the entire life of the fund potentially. Now, at the same time, if anything changes in the market, or if we see a reason why it might be more advantageous to hold on for an extra year, again, it would require a vote of the investor members. And if we did, it could always be extended longer. But again, it's only going to be at the will of the investors who come into the fund.
All right, thank you.
You're welcome.
Yeah, so Elaine is asking, so in regards to, like you said, people like getting in early versus later may pay a higher per share cost. You're saying who handles the valuation of those units with respect to the early investors versus those who come in later?
That's a good question, Elena. So as far as the later investments, it's really, a lot of it's going to depend upon the number of performing properties and the level of performance in the fund. Again, as I mentioned, we want to honor those investors who made the decision to come in early, call it a leap of faith, who came in when there was only one deal in the fund early on, and trusted us to find other properties, compared to those who came in when the fund was near completion and who had already were able to see a track record and potentially all of the properties or most of the properties that were in it. So as far as how that would be calculated, there's not necessarily a set basis for that. That it will be based upon the performance of the fund. However, though, our CFO, Rick, who couldn't join us tonight, has a model in place for that. It has not yet been put into writing. So that will be put into writing before the fund documents are made available.
Okay. And then one more question here is, what's the difference between ROI and IRR?
So ROI is going to be the return on the investment. So this is specific to the investor's capital. So in this case here, the $100,000, the return is relative to that. So for each, in this example on the screen, each $100,000 invested, we're projecting at year 5 would produce another $148,000 of return between distributions and also the return at sale. The IRR is the internal rate of return, which is based upon several factors, but it really just has to do with the performance of the property. And this is factoring in all of the costs at the time of sale, paying off debt services, paying fees for closing. It's a different calculation. It's more of an industry benchmark for the performance of a property. Ramesh, if you don't mind me picking on you for this one here, from your experience in other asset classes, what are some of the traditional IRRs that you're used to seeing at exits?
Yeah, usually it's like 14 to 16% max, because that is how the industry standard is when you're talking about pref 8. To be more specific on IRR gets calculated based on your cash flow that's coming in every quarter. It's like time and money involved in that calculation. So basically, if you do with exit in 1 year, it will be like 50% IRR, depending on how much you return. So this is all projected based on a 5-year model, and usually in the industry standards, it's like 14 to 16%. And this is like 20% or 22% is out of the box.
All right. We probably have time for one more question if there's another one remaining. Again, as I mentioned, I want to be respectful of everyone's time, and we're already a few minutes over, so I do appreciate those who've stuck with us.
All right, so we have a question here that is early versus late investment defined by time when the investor gets in versus the amount the fund has already collected at the time the investor gets in?
So we are planning quarterly reevaluations of the share values. So from the first closing of the fund will happen at the first closing of the property. The documents in the portal right now show November 1st. However, there's no reason for us to actually close the fund any sooner than that first closing. So that will be adjusted. The closing of this A+ property, for example, is expected right now. It's contracted mid-November. However, due to a delay in getting the appraiser on site, we're now looking at likely a late November closing on this. So we'll correlate the first closing of the fund with that. The second closing will happen 1 year later. From the time of the first closing, we will do a quarterly reevaluation of the fund and its performance to make those assessments. And our investor relations team will be in touch at least 30 days ahead of time to let our investors know if they would like to increase their investment amount to achieve that next share class, or just to put more in as they move along. So with that, like I said, I'm certain there will be more questions. We do appreciate you coming out this evening. If you do have more questions, please direct those to members of our investor relations team, Don, Ramesh, or whoever invested you on here tonight. If you weren't, or John, I should say, sorry for leaving out John. However, if you have any further questions, or if you found us through other means and you haven't already met one of our awesome investor relations team members, we'd love to connect with you. If you go to investors.happycampercapital.com, you can access our portal on there. Just put in your information, it'll send a request. We'll reach out and connect with you and help make sure that you're seeing the stuff you want to see and understanding or answering any questions you might have. So again, we're grateful for your investment of your time with us tonight. We really look forward to working with you on this deal and this fund as we move forward. It's going to be an exciting ride. So thank you so much for coming out.
Thanks, Adam. I think I just add one more thing. The fund is open in the portal for commitments right now. So since we have the A+ ready to rock and roll, you can go and commit while we are finalizing documentation.
That's right. All right. Thank you, Ramesh, and thank you everyone for showing up thanite.
Thank you. Thank you so much.
Thank you. Everybody.
Yeah.